Dear viewers, there is a reason why people say cash is king, especially when the world feels uncertain. And it looks like India Incorporation is living by that rule. After navigating through the chaos of pandemic, corporate India has realized the value of sitting on a comfortable cash buffer. Today, Indian companies are sitting on a massive rupees 5 trillion cash pile and their balance sheets are getting leaner by the day. While no company can control external factors like tariffs, supply chain issues, or geopolitical tensions, they are clearly doing their bit to stay strong from within. Sounds great, right? But here is where things get a little tricky. With high valuations and a cloudy economic outlook, companies are eager to raise fresh capital and they are doing it through the easier route, QIPs or qualified institutional placements. This method lets companies raise money quickly from big institutional investors like mutual funds or insurance companies without the long process of a public issue. As per New Indian Express, in 2025 so far, 30 companies have raised over 600 billion rupees through QIPs. In 2024, rupees 1.37 trillion was raised across 95 firms. The fast cash thus received is used to repay loans or clean up balance sheet. In turn, the investors who bring in money get fresh shares. But there is a cost. Issuance of shares means existing shareholders own a smaller piece of the company. This is called dilution. So even if profits rise, your share in those profits could actually shrink. And if most of this money is going towards paying off old debt rather than expanding the business, the long-term growth picture does not always brighten. Which is why retail investors need to be careful before chasing what the smart money is doing. Sometimes it is smarter to track what the insiders or the promoters are doing. When insiders participate in fundraising through preferential shares or warrants, it sends out two signals. First, promoters are confident of companies' growth prospects post-fundraise. Second, they believe that current valuation is attractive enough to put in their personal money. A case in point is Apollo Microsystems. It raised over 7 billion in June 2025 through a mix of preference shares and warrants. The promoters participated. The issue was priced at Rs 114. Today, the stock is trading above Rs 300. Another interesting case is Imagica World Entertainment. After being acquired by the Malpani Group, the company expanded its footprint by acquiring 4 amusement parks in Lonavala and Shirdi and is now setting up new parks in Indore and Ahmedabad. In March 2025, it raised Rs 3.45 billion via preferential issue at Rs 73.5 per share, half through equity shares and the rest through warrants, where 25% of the money is paid upfront and the remaining amount is paid when the warrants are converted within 18 months. Promoters subscribe to 72.4% of the issue. At present, the stock trades at Rs 56, a decent discount to the price that promoters paid. In the theme park industry, entry barriers are high due to land acquisition, capex needs, gestation period, regulations, and operational challenges. In India, we have a growing young population fueling tourism. Both these factors offer structural tailwinds for existing players. Now, this is not a stock recommendation. There are risks in the business, seasonality, long gestation periods, and operational challenges. Still, when promoters put skin in the game and the stock trades below their entry price, it might be worth adding the name to your watch list. Just remember, this is not a stock tip or recommendation, it's a story. And in the world of investing, the best decisions are often made with the right stories. Thank you for watching. Goodbye.